This is a 5-minute time frame chart. After consolidating in the morning, the market rejected higher levels and moved lower. On this chart, you had the chance to take a short trade here and a long trade at this level. However, many traders might have missed it. Let's be honest, it was challenging to catch this reversal trade. That said, you could have entered a short trade here, and it was even simpler because the chart was actually providing trade entry signals. You just had to spot those signals. But you didn't recognize them. So, in today's video, we'll focus on how to spot these trade entry signals on the chart and take trades accordingly. To understand this better, we'll examine live chart examples. But before we dive in, if you find this content useful, hit that like button, and if you're new here, make sure to subscribe and turn on notifications so you never miss our latest uploads. I'll see you right after the intro and disclaimer. Notice how, at the start of the session, the market tries to establish a support zone by forming equal lows on the chart. A minor trend line also develops at a higher level. This indicates that retail traders are waiting for either of these two levels to break so they can take trades in the breakout direction. In other words, points of interest have now formed on both sides of the chart. As a result, this region has accumulated more liquidity compared to the rest of the chart. Now, you might ask, what exactly is a point of interest? Points of interest refer to those areas or price zones on the chart where retail traders place a higher number of orders than usual. It means they are more eager to open trades around these levels. Because there are attention clusters around such zones, these areas are called points of interest in trading terminology. You'll notice these levels appearing frequently on charts, above or below a trend line, near equal highs and lows, at support and resistance zones, or around familiar chart structures. These are the regions where retail traders decide to take trades after analyzing the market, meaning their interest lies there. Consequently, heavy volume builds up due to a large number of retail entries at these points. If you understand the smart money concept, you know that institutional traders rely on high retail participation in these zones to execute their own positions. This is crucial. Only then can their large orders be filled. That's the reason for the volatility you often see in these areas. Having grasped the concept of a point of interest, let's get back to our chart. Since these zones have formed both at higher and lower levels, a large amount of liquidity exists within this region. If the market intends to move upward from here, the liquidity below must first be cleared out, removing retail buyers from the equation. Similarly, for a downward move, retail sellers waiting to short at higher levels must be taken out. After a while, price finds support near the lower zone and gradually pushes upward, breaking through its prior high in the trend line. Once the market holds this support and breaches the trend line, many retail traders assume it's a bullish breakout and enter long positions instantly, without waiting for candle confirmation. As a result, their stop losses are placed below this level. At this stage, buyers have their stop losses here, while retail sellers have theirs placed here, creating a pool of liquidity. Soon after, the price reverses downward, forming a long upper wick and a rejection candle on the chart. This confirms that the breakout has failed. The market has swept the liquidity from higher levels through what's known as an inducement or breakout candle. This action clears out the stop losses of short-selling retail traders, effectively removing that liquidity. Now, only the stop losses of retail buyers remain in the lower region, forming a sell-side liquidity zone. Whenever you analyze a chart, you'll notice both sell-side and buy-side stop losses. When a retail trader shorts a stock or option, selling it at a higher price and buying it back at a lower one after the market drops, they generate profit. This means, after selling, they must eventually buy it back. If the market declines, they earn. But if the market rises, they'll need to repurchase at a higher price, leading to a loss. To manage that risk, they place a stop loss at a higher level. In other words, a short seller sells at a higher price, and if the market moves upward, they lose money. When price moves against their position, they must buy back at elevated levels to limit the damage. Hence, a short seller's stop loss essentially acts as a buy order. For example, suppose I sell an option for 100. If the market falls, I profit. But if the market rises, I'll have to buy that same option back at 120, causing a loss. To prevent this, Short sellers typically place stop-loss orders above their entry level. Conversely, buyers place their stop-loss orders below their purchase level. This means that, on the chart, buying liquidity exists at higher price zones, while selling liquidity forms at lower zones. This is a fundamental concept, but it's essential to understand these basics clearly before moving to more advanced strategies. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this October 10th. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500 plus 61% off for pre-bookings before October 10th. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. Now, coming back to our chart, the market has already absorbed the liquidity from higher levels. That leaves us with two potential outcomes. Either the market drops further, drawing out the liquidity below, or, if it intends to move higher again, it will need to consolidate and rebuild liquidity from retail participants. However, there's significantly more liquidity visible on the lower side of the chart compared to the upper side. Additionally, the price action shows a bearish shooting star-like candlestick, suggesting a potential short entry. This pattern occurs when rejection from higher levels drives the candle down, creating a long upper wick. Moreover, the red candle closes below the previous green one, confirming a bearish signal. This setup gives us 3 strong reasons for a short trade here. First, the market has completed a liquidity sweep. Second, a bearish shooting star candle has appeared. Third, entering a position here allows us to place the stop loss above the resistance zone, which safeguards it effectively. This means we can execute a high probability trade here with minimal risk. You can aim for a profit target at least twice your stop loss. Always stay alert and recognize every trade entry signal that appears on the chart. To master this skill, begin by practicing with small position sizes to build confidence and mental discipline. Now, let's move on to the next example. This is a 5-minute time frame chart. After a strong upward move, the market consolidates at higher levels and then declines. This example, like the previous one, is also based on a liquidity sweep. But how? Let's break it down. During this consolidation phase, many retail buyers who missed the earlier rally wait to go long on a breakout from this zone. At the same time, some retail traders place stop losses above the range to initiate short positions here. This creates a concentration of liquidity in this area. After consolidation, breakouts generally fall into 4 main types of price movements. First is the rally-base rally, where price rises, pauses at a higher level, forms an inducement, sweeps liquidity downward, and then continues upward. Second is the rally-base drop, where after a rally, price consolidates, creates an inducement or a fake breakout at the top, sweeps the liquidity, and then reverses downward. Third is the drop-base drop, where price falls, pauses briefly, and breaks lower again, clearing liquidity beneath the range. Fourth is the drop-base rally, where price declines, consolidates, sweeps liquidity below through an inducement, and then reverses upward. This structure often appears in bullish markets, while the drop-base drop is more common in bearish conditions. Now, across all 4 of these price scenarios, 2 things remain consistent. First, the inducement, which is a fake breakout, and second, the liquidity sweep, when the market trends downward and breaks out from a consolidation zone. It often gives a false signal, trapping retail participants. Retail traders typically enter in the breakout direction, producing high liquidity. Institutions then use this liquidity from retail traders to execute their own large orders. This behavior can be observed on charts across all time frames. Therefore, whenever you see a consolidation forming, never enter a breakout trade blindly. First, verify whether an inducement has appeared on the chart. For instance, after this inducement candle, the market drops sharply instead of rising, trapping all the retail buyers. Without an inducement, a liquidity sweep doesn't occur, so always remember this rule. As shown in this 5-minute chart, after moving higher, the price consolidated near the top and then broke its previous swing high with a strong bullish candle. Many traders assumed this was the start of another bullish leg and entered long positions. However, the price quickly reversed downward, trapping them. This demonstrates how inducement candles and liquidity sweeps can serve as powerful trade entry signals. Now that we've understood fake breakouts, let's move on to the next example. This is a 15-minute time frame chart. After a steady upward move, the market drops sharply from a certain point and ends the day at lower levels. Here, the market rejected a psychological round number around 55,000, which seems reasonable. However, even after closing lower, the market broke through this psychological level the very next day instead of respecting it, and continued rising strongly. Now, the question that might be puzzling you is, why did this happen? What caused this sudden reversal? To understand it better, let's shift to the 5-minute time frame. At the start of the session, the market gradually moves upward, following the previous day's bullish trend. As a result, many traders observing the bullish structure begin placing buy orders at every minor dip. This consistent buying activity creates a substantial amount of liquidity, forming what's known as a downtrend liquidity pool. A liquidity pool refers to a zone where a large number of stop-loss orders from retail traders accumulate in the same direction, typically within a defined price area or range. In this case, buyers have their sell stop orders placed at lower levels. As the price approaches this psychological level, many of these buyers start exiting their positions, adding selling pressure to the market. Those who entered long positions near the highs, expecting a breakout above 55,000, also begin closing their trades. This chain reaction causes a rapid decline below the higher level. Since the price respected the psychological barrier, every upward move attracts fresh selling interest, resulting in a close at lower levels by the end of the day. Now, if you observe closely, the buyers have completely exited from the lower regions of the chart. However, at higher levels, many short sellers remain active, holding their trades overnight because they expect further downside for profit. This leaves more liquidity concentrated at the higher levels compared to the lower ones. The next day, when the market opens near the same zone and initially dips, additional traders start short selling, increasing the overall liquidity on the chart. After a brief downward move, the market triggers the stop losses of the remaining buyers in this region, clearing out that liquidity. Then, it quickly reverses upward, sweeping away liquidity from the higher side and catching the short sellers off guard. A similar scenario can be observed on the 5-minute charts. As the market moves down from higher levels, it builds liquidity for short sellers. When trading begins, the price initially drops, forcing buyers out of their positions, and then swiftly reverses upward. This move triggers a chain reaction of short covering as sellers rush to exit their trades. If you pay close attention, you'll notice that patterns like this appear frequently across different charts. That's why, whenever you analyze a chart, it's essential to mark your key support and resistance zones. At the same time, focus on understanding the market's actual behavior behind the price movements. Only then will you be able to interpret charts effectively and plan precise trade entries. That's all for today, traders. Thanks for watching this video. Excuses don't bring success, consistent effort does. If today's video gave you a new perspective or pushed you to take action, hit that like button, and if you're not part of the community yet, make sure to subscribe and tap the bell icon so you never miss when fresh strategies go live. Stay driven, stay focused, and keep leveling up. I'll catch you in the next one.